this is probably one of the greatest opportunities of our lifetime, okay, as long-term investors, because the stock market game has not changed, all right? And by the end of this video, if your company has been performing incredibly well, the fundamentals and the financials have been growing, however, the stock has been depressed, you will understand exactly why this has been the case, and hopefully as a result of this video, this will give you more conviction to hold on to your investments, see your investments as part ownership of a company, as opposed to the retail narrative that we are bag holders. So this video will expose exactly the dirty tricks that Wall Street have been playing to essentially depress, suppress, and frustrate retail investors to the point where they're now selling high quality companies on the cheap, and you will discover exactly who's been buying these stocks on the cheap. Okay, so if you gain any value, please make sure you smash that like button. If you're new to the channel, hit that subscribe button and the notification bell if you want to stay up to date with all of my latest videos. If you want to join my Discord group, the Patreon link is in the description below. With that said, let's dive into it. So this is from the book 100 to 1 by Thomas Phelps, okay? It was written in 1970s, okay? And this particular chapter was titled Stock Market Manipulation. Now, this is what Thomas Phelps said, okay? The stock market is almost unique that in the way to attract buyers is to mark up the price of the merchandise you want to sell. Facts, okay? The stock market is the only place in the world whereby what you want to buy, the more expensive it is, the more you want to buy it, right? In comparison to if you go to the supermarket, I'm not sure about you, but for me, when I see for sale stickers, right? When I see that red for sale stickers, it becomes more attractive to me. And I'm sure it's probably the case for you. However, with the stock market, when the things that we want gets cheaper, it's almost associated with being a negative, okay? So the stock going down means that the company is bad, which is just not the case. And the stock going up means that the company is good, which also isn't the case. But this is the confusion that a lot of retail investors face many times. So conversely, if a large operator wanted to accumulate a position in a stock with great long-term potential, the least effective thing he could do would be to bid up for it, okay? So essentially, you've got a company that has great long-term potential. I mean, it's clear, you're seeing the results in the financials, the fundamentals, maybe the company are expanding, and you're beginning to see the results of that expansion in the financials, you know, top line growth, bottom line growth, maybe margins are improving, maybe they're approaching positive free cash flow, they're strengthening their balance sheet, you know, the company has great long-term potential, but the least effective they can do is make it more expensive, okay? So on the contrary, if he could supply the stock on each embryonic advance so that after a year or two, speculators agreed that it was acting badly. So essentially, if they can depress the stock, keep it low for about a year or two, and the long-term investors who are more stock price orientated as opposed to business orientated, they can agree that, yo, this is a crap stock, okay? I'm selling out, all right? They agree that it's acting badly. So the stock is acting badly, not the company. The stock is acting badly. They would sell to him, so the large operator, so the retail investors who have agreed that the stock is crap, they're going to sell it. They will sell to him all they had at successively lower prices. So essentially, retail investors will cut their losses and sell just because the stock has been going down, right? So remember, this was written in 1970s, and this exact strategy is being applied today. Now, let me prove it to you, okay? So we have the chart of OPENDOOR. I'm going to give you many examples, all right? I'm going to give you examples of PLTR, Big C. It's been happening pretty much since mid-February last year. So OPENDOOR, right? You can see that it peaked here on the 12th of February. And what has the stock done since that period? So it peaked here at about $39, and the stock is now down 70% plus, okay? So since mid-February, the stock has been constantly battered. Now, bear in mind, this is during a period whereby the revenue has been going in one direction. As you can see, since December 20th, the revenue has pretty much been more than doubling quarter over quarter, to the point whereby if you look at Q4, they reported $248 million in Q4, and analyst expectations for Q4 2021 is 3.14 billion. So think about it. They reported 248 million in Q4 last year, but this year, Q4 2021, analysts expect them to report 3.14 billion. So year over year, that's over a 1000% growth in just the top line. Let that sink in for a minute. Like, this is VC startup level type of growth, 1000% year over year growth. Okay. Now we can determine that the company has been doing great. Okay. The stock has been absolutely destroyed and decimated since mid-February 2020. So almost over a year. Retail investors are getting frustrated. I mean, every day is a down day. I'm bag holding Opendoor. This stock is crap. Going to sell for much cheaper than I purchased the stock. So essentially sell at a loss. And guess who is on the sideline ready to take your shares? Institutions. Okay. Look at the crazy institutional ownership since February. So we established that the stock started to crash from mid-Feb. But from March, look at the institutions just vacuuming up all of the retail investor shares. It's insane, guys. This is more than a triple up on where they were in February. But as soon as the stock started to crash, they started loading the boats, and they have continued to load up on companies like Opendoor as the company has been performing well, but the stock has been getting cheaper and cheaper. They have loaded the boat continuously. Even look at it in January, okay? January 2022, this year, institutional ownership still remains at pretty much an all-time high. And if you take a look at Whale Wisdom, all right, so from Q2 to Q3, it gives you an update of where the stock stands amongst hedge funds and institutions. And if you can see, so in Q2, so the prior quarter, Opendoor was a top 10 stock in about 13 hedge funds, okay? But as of Q3, it's now top 10 in 18 hedge funds. This is all while the stock continues to get cheaper and get depressed. And if you look at the funds holding, it grew 26% quarter over quarter. So from 235 funds to now 297 funds. Insane. Like I said, the stock has been getting cheaper. Retail investors are getting stressed, getting fed up. I'm a bag holder. They're selling at losses. Institutions are like, thank you very much. And the growth has just been absolutely insane. Okay. It's not just Opendoor. Another company that has been crushing it quarter over quarter, Palantir. Okay. So if we pull up Palantir stock, the stock peaked at about $45. And, it was quite high, quite expensive. But ever since then, right? So from its peak early 2021, I mean, the stock is now down over 60%, call it 64%, right? But what have institutions been doing within that time? They have been loading. So you can see, so from March, they began loading the boat on Palantir, and they have continued to load the boat on Palantir as the stock has gotten cheaper. Now, is anything wrong with Palantir? Absolutely not. You can see, take a look at their revenue. It's been up and to the right. It's been beautiful. If you scroll down to the bottom line of the company, you can see it's going in one direction. The net losses have been reducing each and every quarter. It's a similar story with Opendoor, and I want to bring up Opendoor's net income because I know there's going to be some haters in the comments saying, oh, Opendoor not profitable, Palantir not profitable. But look at the trend, okay? They've been losing less and less money with each and every quarter, and Opendoor is very close to breaking even at the bottom line. But again, institutions are seeing this. The fundamentals and the financials of the businesses have been improving. Meanwhile, the stock has been absolutely destroyed, but institutions have been loading up. Meanwhile, Palantir shareholders who have gotten frustrated with the stock, completely ignoring the performance of the business, oh, the stock is going to go to zero, they sell out of losses, and institutions are like, thank you very much. It's a similar story with Big C, Big Commerce. This is a position that's in my top 7 largest holdings. It's down over 80% from its peak towards the end of 2020/early 2021. But again, institutions have been loading up. So the stock has been going down, but the institutional ownership has been going up, as well as the business fundamentals and the financials have been going up. Now, if you think this is all just one massive coincidence, it's not. I can assure you it's not. They know exactly where we're positioned. This was a recent article that I shared with my Discord from Wall Street Journal. Take a look at how this article reads. It says, last year, amateur investors, so that's us retail investors, took financial markets by storm. This year, Wall Street professionals are watching them closely, okay? So some 85% of hedge funds and 42% of asset managers are now tracking retail trading message boards, according to a survey by Bloomberg Intelligence. So your Reddits, your YouTube, your Discords, where retail investors are gathered and are choosing to invest in high quality companies, Wall Street knows, okay? And a lot of retail investors are parked up in high quality, small, mid, and even now large caps, and they are taking full advantage of this by depressing the stock even further. JP Morgan Chase & Co. in September introduced a new data product that includes information on which securities individual investors are likely buying and selling, as well as which sectors and stocks are being talked about on social media. If you ever wanted proof, there's your proof. The game has not changed. Exactly what we are doing. So exactly what Thomas Phelps described in his book 100 to 1 in the 1970s as this is what was going on in the stock market at the time. Fast forward to 2022, it's the exact same thing. And this is why I call this moment one of the greatest opportunities of our lifetime, because we know it's not going to last. As soon as these institutions and large operators are done loading the boats, they're going to start propping up the price. You're going to start seeing them raise the price targets. They're going to start promoting the stock, and then they're going to bid the price up higher. It's always been the case for centuries now, okay? This is how the stock market game works. The only thing that you need to ensure of is that the companies continue to perform. And it's only a matter of time before the stock price catches up to the fundamentals. Now, in my Discord, we have a channel called Before You Panic Sell. And essentially, I share some information, some videos, some motivation, and reasons why you shouldn't panic sell, essentially. But I shared this last week.
The question you have to ask is, people sell out of the market at lows. The ordinary investor does that. They sell their stocks in 08, 09, and they buy them back when the prices start to improve. But of course, that's an oxymoron because they have to sell their stocks to somebody. Okay. So the question is, the real question is how do stocks redistribute during a bear market? And JP Morgan very famously said that a bear market is when stocks return to their rightful owners. All right. Which unfortunately is wealthy people.
And I absolutely loved that JP Morgan quote. In bear markets, stocks return to their rightful owners, all right? Just how it happened in the 08-09 crisis, as Bill said, when the stock market crashed, it was the wealthy, the patient investors and the institutions who were buying those shares and eventually grew their wealth on the recovery. And, retail investors started rushing back in when stocks started to go back up. Just absolutely fickle. Now, this next clip is from Warren Buffett. Here's what he has to say.
People should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business.
And there you have it. I don't think there's anything more I can add to that. Just don't be a dumb investor, essentially. And the last thing I want to leave you with is this quote from Warren Buffett again. He says, "Only when the tide goes out do you discover who's been swimming naked," okay? What I gather from this quote is if you're investing in companies that are fundamentally very strong, that are financially very strong, okay? In bear markets, the crap companies, the workhorses, the Lordstown Motors, the Nikolas, these companies will not survive, okay? They won't survive because they've been swimming naked. However, the companies that we invest in like OPENDOOR, like PLTR, like Tattooed Chef, all of these companies that are fundamentally and financially strong, they will survive this bear market and they will go on to thrive as long as the management continues to execute. So with that said, make sure you buy and verify with each quarterly earnings to make sure your companies are on track. If your investment thesis is getting stronger with each quarterly results, then don't be dumb, as Warren Buffett says. hold your position or probably even add to your position. You want to reward yourself for picking great companies that are growing by essentially owning more of the business and enjoy these cheap prices while the stocks are on sale. So I hope you gained some value from this video. I hope this helps to build your conviction and also to educate you on how this game has been played, how it's being played right now, and how it will continue to be played. And I mean, we have such a huge advantage because we understand how the game is being played. So thank you so much for watching. Again, if you want to join my Discord group, the Patreon link is in the description below, and I'll catch you in the next one. Peace.